and welcome to my first quarterly update for the year that is 2025. Now, I think it would be an understatement of the century to say that it's been a volatile first quarter of this year. We've had tariffs, geopolitical uncertainty left, right and centre, and plenty to unpack in this quarterly update. So in this video, we're going to take a look at what's happening right around the world. Of course, we'll be covering the tariffs, what it means for investors, where there are opportunities, and of course, taking a bit of a look at key markets around the world in terms of what's happened and where we are seeing opportunities. So let's dive right in and let's have a bit of a look at what's happening around the world. Now, looking at global markets first and foremost, it has certainly been quite different to what analysts were expecting at the start of this year. Most forecasts were for high single digits, low double digit growth across most global indices in 2025. Now, it is only the first week of April, so it is very early days, and these return estimates may still be quite accurate. Really, nobody quite has that crystal ball to tell at this current point in time. But looking at key markets and key indices, since the beginning of this year, we've seen the S&P 500 down a little over 13%. And if we look at some of the key stocks from the highlight reel, without a doubt, the market darling of 2024 was Nvidia, and that stock year to date is already down about 17.4%. Of course, we've seen Tesla all over the place, depending on which day you look. That stock has been incredibly volatile. We've seen Amazon down 7.8%. We've seen Apple down a little over 14.19%. And stocks like Microsoft down just over 1%. And what that highlights, even within the technology sector, is we are seeing a dispersion, a rotational shift from expensive growth stocks to more undervalued equities that are delivering those returns, strong financial positions, low levels of debt, low need to be able to refinance that debt, and are trading at reasonable multiples. And that is happening not just in the tech space, but right across the board. So some of these headline figures that we are seeing, and even just headlines that we are seeing, is really masking the dispersion that we are seeing, that shift from growth into value stocks, that shift from US into European and Asian equities, and that shift from, let's say, expensive credit into government bonds like Australian government bonds, for example, and even a shift from expensive large cap stocks into more small and mid cap stocks where there appears to be more upside. Now, we'll unpack plenty of that and those opportunities in this video today, but that just gives you a bit of a highlight of what is happening. Now, let's dive into some of the key events of 2025, and let's start with the tariffs. Now, the biggest market-moving event of the first quarter and shortly thereafter has been Liberation Day, Trump's tariffs for all policy, which really left very few countries out of the mix. We saw 60 countries impacted. We saw Australia hit with about a 10% tariff, China with around 54%, once you actually sift through the headlines. We saw Canada and Mexico largely left out, although Canada has its own challenges moving forward in this current environment. So really it was a tariffs for all sort of policy and announcement. And naturally we've seen a bit of a sell-off as investors and traders try to figure out exactly what this means for investors. And these knee-jerk decisions never really proved to be the most sensible ones in the long run. More on that to come. Now, one of the most important things to realize with the tariffs is that they have been introduced by executive order. So there is no guarantee that they will be made permanent, that they will be permanent in their current form, that some won't be wound back, or what we believe to be far more likely as an outcome is that some will actually be individually negotiated with certain countries moving forward and wound back or watered down, diluted from the current form and from the current announcements that we are seeing. So what does that mean for investors? Well, in all likelihood, it's going to mean that there are plenty of opportunities as the dust does settle. No doubt there will be more volatility to come, particularly with Trump in power, more announcements on tariffs potentially, but we do believe that there are going to be some incredible opportunities for investors playing that long-term game. Now, the other key announcement that we have seen has been the Australian government election, Australian federal election, I should say, has been announced for the 3rd of May. We saw the Australian federal budget recently handed down. We'll touch a bit more on that later. But the election has been called for the 3rd of May, which could have some impact on both Australian expats and Australian investors in general and the broader market. So we'll touch on that a little bit later. Now, just coming back to the tariffs for a moment, one of the key data points that we are all watching, outside of just whether those negotiations take place, whether some of those tariffs are watered down, is exactly what happens to US government bond yields. See, if government bond yields rise and that government debt gets more expensive, then potentially that's going to make it more challenging for Trump to extend tax cuts, for him to really look after the more wealthy friends of his at that higher end of town. Whereas if bond yields do come down, tax cuts do get extended, then that may mean that this is the buying opportunity that we should all be taking advantage of. The reality, the truth may very well sit somewhere in the middle, that there are opportunities to be taken advantage of and that it won't quite be a smooth ride over the course of Trump's term, or maybe just over the course of this first year. Now let's have a bit of a look at what's happening in the United States outside of the tariffs that have been announced. Now, I mentioned the volatility that we have seen in the United States, and that has largely been led by the more expensive tech stocks, so the tech giants, the Magnificent Seven as it were, the FANG stocks as they're commonly known also. The decline of the largest 10 players in that space has been larger than the broader market decline. So that gives you some sense on where that selling pressure has occurred, where those extended valuations really sat in that market. We saw a lot of retail investors, a lot of influencers for that matter, telling everyone you just need to go and buy the S&P 500 or just go and buy the NASDAQ, QQQ, often referenced, and that's really all you needed to invest in. And of course, we have seen a lot of retail investors panicking over the last few weeks. Not to say that there isn't upside there to come, or to really give you any advice. Obviously, you need to go and seek what's right for you, but it does highlight the importance of diversification. Now, what we have also seen in the United States is, of course, what the Fed is going to do next, and that is really what we are watching. The current chair of the Federal Reserve in the US has said that they are in no hurry to cut rates, to cut the cash rate in the United States. Now, will this current volatility put pressure on them, force their hand to cut rates? Well, I think a lot of that will really be dependent on what happens with inflation. So if inflation is more sticky and inflation remains stubbornly high in the United States, then that may mean that we don't see those rate cuts anytime soon, or they are slower to be rolled out. So of course, as always, the importance of diversification is certainly there, but I would be watching for opportunities as this current volatility continues to play out in the US, both in the tech space and outside. Let's have a bit of a look at what's happening in Europe and the UK. Now, European markets in the first quarter of 2025 actually showed remarkable resilience, and that really highlights the importance of diversification. But not only that, it also highlights the fact that stocks can often perform in an uncorrelated manner to what the economic data and the economic outlook may be telling us. See, many investors have been scared of investing in European markets, given the volatility, given the geopolitical tensions, but we saw for the first quarter of this year, the German index up 15.6%. And much of Western Europe also presented quite strong results for that first quarter. A lot of those stocks are quite defensive in nature, and naturally this current volatility has meant investors flocked to safety, particularly some of those high dividend players in that space, and we do expect that that may very well continue. The UK, on the other hand, we think has challenges ahead of it. The recent tax reforms we saw, the changes to the non-dom domicile status, the changes to inheritance tax, and the wider net that has now been cast. We'd probably prefer to err on the side of caution there, but we will certainly be watching this space, and we are hopeful that some of those recent changes that they announced are actually wound back as we move forward. Whether wound back in full, watered down, diluted, again, we remain hopeful, but yes, we're certainly watching this space because it is going to have an impact on any Australian expats who either already live in the UK or might be thinking of a move there. So again, watch this space, but we do feel there are going to continue to be opportunities in those European equity markets. Let's have a look at what's happening closer to home down in Asian markets. Now, looking at Asian equities, we saw a relatively mixed bag in that first quarter of 2025. Obviously, the tariff concerns placed some pressure on those more export-sensitive markets like Vietnam. And again, everyone is watching that space to see exactly what happens in terms of those tariffs, whether they're negotiated, again, diluted from their current form, changed in some way, may present opportunities for investors going forward. Of course, everyone watching Chinese equities, the Chinese market broadly, we did see a bit of a flight out of those expensive US tech stocks into Chinese tech stocks in particular, given the valuations were very, very cheap relative to their US counterparts. So it almost acted as a bit of a hedge against any sort of market volatility. Now, what that looks like moving forward, again, time will tell. We have continued to see a bit of a sell-off in Chinese equities over the last week, but again, we do feel there will be opportunities there moving forward. Investors are expecting that there will be more stimulus announced. The Chinese government is fully aware they need to drive economic growth domestically, and so there will in all likelihood be more stimulus packages announced right across the board. So again, watch this space. Now, here in Singapore, we didn't see really a great deal of protection in terms of the defensive nature of those Singapore equity markets. The banks, property in particular, we did still see a bit of a sell-off there over the last quarter, and particularly over the last week, given the recent tariff announcements. Again, that may very well present opportunities for investors, particularly those that might be looking for a steady yield. Now, let's have a look at what's happening on the ground in Australia and what investors should be paying attention to. Now, back home in Australia, the ASX 200 was relatively soft for that first quarter of the year. The banks were quite soft, which obviously drives a lot of that ASX 200. And of course, commodity prices were also relatively soft. We did see a bit of stability in healthcare, in energy, and there were certainly some standout stocks in that first quarter. Of course, what many investors are watching is the Australian dollar. Particularly if you're a foreign investor looking to get exposure in Australia. If we look at the Singapore dollar compared to Australia at the moment, as I film this, it's the first week of April, we are currently trading at 122 off the back of 123 only days ago. So naturally that presents opportunities, whether you're looking to pay off a mortgage, roll over a term deposit, put cash in the bank, contribute to super, pay off your HEX, whatever it may be. This low Aussie dollar, particularly if you're an Australian expat, is certainly an opportunity that we should be very, very mindful of. Now, I mentioned earlier, the federal budget was also handed down recently. There was not a great deal in that. We did see a tax cut announced for that first tax band. So between 18,201 and 45,000, the current tax rate is 16%. That is currently scheduled to be reduced to 14% over the next 2 years. 15% next year, 14% the year after. So what that'll mean is you'll save about a whopping $560, $570 odd dollars. And hey, far better that money be in your pocket than the Australian tax officers, but really isn't going to change the lives of too many. And anyone who earns over 45,000 will receive that full benefit if that tax cut is actually extended. I mentioned earlier, the election at a federal level has also been called for the 3rd of May. So watch this space. There's not really a great deal of headlines or of key announcements in terms of what could happen around negative gearing or franking credits or tax residency, but naturally watch this space. There is still a month to play out between us and the election. So watch this space. We'll certainly be keeping everyone updated there. I mentioned earlier also that we have also seen a bit of a flight to Australian government bonds. Yields have been very healthy. The Australian dollar also quite healthy. So again, for investors looking for that stable income, for a bit of stability in this current volatility, has certainly been a reasonable place to be invested. For many of our clients, we've held some of those Australian government bonds for some time now, and that has proven to be quite sensible, as has the gold price, given the recent uplift. Now, Obviously, plenty going on as we look across the globe. So what does all of this mean for investors? How should we be positioning ourselves? Should we be going to cash? Should we be buying more? Where are the opportunities that are being created in this period of volatility? So as we look at the outlook for the second quarter of 2025 and beyond, what are we doing as investors, as advisors? How are we positioning client portfolios for what is to come? Well, first and foremost, the number one worst thing that anyone can be doing during this current period of volatility is going to cash. Selling out your portfolio, unless you need that money in 12 to 18 months, that is always going to be a terrible thing to do. It does not stand the test of time, as the data suggests time and time again. Now, if you do need that money in the short term, of course, reach out to your advisor, seek advice to work out exactly what's right for you. But if you don't, we should be looking at this the other way. Now, the other more common mistake that we see people making during these periods of volatility is they often pause or reduce or cancel regular contributions to their investment portfolio. Now, if you think about dollar cost averaging from a logical, pragmatic standpoint, the whole premise of dollar cost averaging is that you buy when markets are high and you buy when markets are low, and over the long run, you get a sensible entry price. Now, if you're not prepared to buy when markets are volatile and markets are down, that does not work. And all you end up with is an expensive entry price because you've only bought when things felt comfortable, when things were rosy, when your bonus was coming in, when everyone was happy, getting a pay rise, economic growth was strong, and there was no geopolitical instability. So naturally, if anything, we want to be maintaining those contributions, but in all likelihood, if possible, looking to increase them or make ad hoc top-ups if you are able to. Now comes obviously the important question of, well, where should we be putting that money? Where should we be putting those increased allocations? Naturally, diversification is key. But if we look at some of the key sectors in terms of what has happened, US markets, following the recent downturn, have become quite attractive in terms of valuations. That larger end of the technology sector is trading at about a 5 to 8% discount to those fair values. Now, looking a step further in the small to mid-cap space, we've actually seen that space trading at a discount of between 18 and 25% relative to those valuations. So we do think there's going to be some good opportunities in that small to mid-cap space. China and Asian and emerging markets, we do believe there will be ongoing upside coming, particularly given the diversification that investors are seeking. And as I mentioned earlier, Australian government bonds continuing to look quite attractive. So naturally, there are opportunities right across the board. Is it time to be dumping everything into the market? I would rather take a bit of a staggered approach and see what plays out for the course of this year. I don't think it's the time to be taking crazy bets, but I do think it's the time to have a steady hand, stay the course, take advantage of opportunities as they arise, and no doubt there will be plenty. Whichever way these tariffs actually play out and whichever way Trump's presidency continues to play out, there will be opportunities for investors moving forward. So if you have any concerns, questions, want to talk about how to strategize, how to take advantage of the current volatility, reach out, book in a call, shoot me a question, drop me an email. I'd love to have a chat. You are always welcome to do so. If you've got value out of this video, feel free to share it with anyone who might be concerned about the current volatility, around what to do, what they should be thinking about, and of course, the path forward. But thank you very much for tuning in. I appreciate you giving me your time. I look forward to speaking with you soon. And until we speak again, all the best, stay the course, and safe journey through this volatile period.